I'm Howie Lim. This is Money Hacks by the Business Times. I won't lie, I dream about retirement. I can't wait. But I fear not having enough money, so I continue to productively contribute. But apparently, the trend of micro or mini retirements is on the rise. Some call it investing in yourself as well. A rose by any other name. This is possible for the regular Joe? Really? How do we deal with possible ramifications on our careers and long-term financial goals, i.e. the nest egg? Welcome to Money Hacks, a podcast series by the Business Times, where we explore useful financial tips to help you on your money managing and wealth growing journey. I'm Howie Lim. And today we're getting expert help from Ishan Sarkar, Head of Wealth and Premier Solutions at HSBC, Nick Tong, Head of Intermediary Distribution, Southeast Asia at Rowe Price, and Jason Ng, Senior Wealth Advisory Lead at Syfe.
Hi, pleasure to be here. I think it would be good to kind of define what is a mini retirement, right? Because obviously to each and every individual, it means different. So I think for mini retirement, a planned strategic pause from your career. So it's not so much about taking time off work and then focusing on a side hustle per se. It is really spending that extended period of time on yourself. We kind of frame it into a project you. So it's not so much about a pause in your life stage, but rather you're just trying to prioritize you. That's where you have like different budgets, different timelines, different efforts to it as well. The key here is a separation of funds. Try to separate your funds into 3 different buckets. When you have it in a 3-bucket system, it makes it very focused. So in the first bucket, you could have like say a long-term retirement fund towards a nest egg that you're trying to build. In the second bucket, that's where you have your emergency funds. Anything unexpected happens, you can always tap on it. The third bucket is your project you, where you fund your mini retirement. Essentially, having this 3-bucket system, it keeps you very laser focused on what you're trying to achieve here as well.
Apparently, this is a relatively new phenomenon which is gaining traction across all age groups. However, some are going about it with a lot of optimism, but no plan. Gen Zs are more confident about retirement than millennials at only 45% and Gen Xs at only 38%, but 72% of Gen Zs have no plan. To be young and fearless. Not a good idea though, according to Nick Tong from Rowe Price.
Many said that they would consider having a small retirement after they have at least 300,000 Singapore dollars of savings. Almost 2/3 of them think they need at least $1 million before they can comfortably retire. The most important thing for you to start today is to plan. Take a step back, look at what you're spending today, what you think you're about to spend in your mini retirement or when you eventually do retire for proper, and figure out with inflation how much some of these things would actually cost you. Healthcare, think about inflation costs, create a dedicated bucket of savings for any potential mini retirements that you're thinking to do, and adjust for these long-term breaks in your income and review it on a very regular basis. It is also really important for you to stick to your plans once you create them, because the worst thing that can happen is something, for example, in the financial markets, causes you to feel spooked out, and then you might sell or buy at the absolute wrong time. And to potentially seek professional advice if you are unable to create this plan on your own.
Early planning, very essential. Make sure you have a financial planner who is helping you on that. And lastly, would be to have the right financial products in your financial plan. It's not a one-size-fits-all. Depends on a person's individual plan themselves, their risk appetite. There are certain clients who prefer to take part in dividend-paying stocks or income-paying funds. There are certain who actually prefer a diversified portfolio so that they have a much more sustainable financial portfolio. What is again very critical is to actually work with a financial planner to plan that out. We also have a tool called Financial Planner or the Future Planner, and we use Future Planner to do exactly that. We plot these events, and then how do you then use financial planning to fund those events? Financial planning also needs to be dynamic.
Looks like Ishan Sarkar from HSBC also feels some wealth advisors' help might be needed to help with the planning. And are there specific financial products or investment strategies best suited for individuals aiming for a mini retirement? Here's Nick Tong.
So I think for Singaporeans, we would have some form of insurance So be it an annuity or some kind of endowment. We've been fortunate in Singapore that real estate is something that many of us own as well, and that also plays into another factor in retirement planning. Traditional investments in equities, in fixed income, and in REITs also play an outsized role when you're thinking about retiring and retiring comfortably, especially when you think about mini breaks in between. What if you do plan to take a mini retirement, and what it actually then means for re-entry into the workforce and whether there is a break in your cash flow? It is very individual. It depends if you are taking a sabbatical from work and you know for certain that you'll be returning to the same job. I think that would be the most clear cut, given that you can plan for your salary as well. Or if you then take a little bit of a career change and you have a bit more uncertainty around what you will be coming back to in terms of your earning potential and in terms of exact timelines as well. Most people in Singapore who, based on our survey, who plan to take a mini retirement do not foresee doing it for more than a year.
What we try to do is to take on a more holistic approach, a layer-based approach. When you have a layered approach, if you take the 3-bucket system, so the first bucket where we talk about the retirement fund, that's where we look at products like, say, global ETFs, equities, where typically the long time horizon helps in your favor. Looking at the second bucket, emergency funds, that's where you have things like low risk, high yield savings account, cash management solutions that are pretty much available for any individual investor today. When you look at the mini retirement bucket, which is the Project U, having a 2-layered approach might come in handy. So the first layer could be like a growth engine. Start to focus a little bit more on the returns. The second layer is more towards a living expense layer where you try to cover your living expense during this period of time. So depending on where you are from the start of your mini retirement, say if you are 5 years before your planned mini retirement period, then that's where you can focus more on the growth engine, where you start to not have your idle money lying there doing nothing, but rather try and put it into lower risk investments.
Still to come, what do Jason from Syfe, Ishan from HSBC, and Nick from Rowe Price think about the psychology and emotional aspects of taking a mini retirement or investing in Project U? More with our experts in a moment.
Lens on Singapore is now bigger and better. The same deep dive exploration of socioeconomic and geopolitical issues which impact our lives here in Singapore and the region is now a video podcast. If watching a conversation is your thing, join Clarissa Montero in monthly conversations about things that matter. Subscribe to the BT Lens On playlist in the podcast tab of the Business Times YouTube channel and start watching today. BT Lens On Singapore, now available in audio and video.
And now, back to Money Hacks from the Business Times.
Welcome back. So how do we manage the psychological and emotional aspects of a mini retirement, especially regarding potential guilt about not earning or concerns about re-entry into the workforce? And how do these factors influence financial decisions as well? Here's Ishan Sarkar from HSBC.
That's a great question, Howie. And again, we support our clients in this journey as well. But this is something which we, even as employees or managers within HSBC, we encounter as well. Before you start thinking about taking this mini retirements, you need to understand the policies of your employer. What's the unpaid leave policy? What's the sabbatical leave policy? Getting a very good understanding of it will help you then avoid any kind of negative surprises. We strongly encourage is have that plan early and make sure that you communicate that plan very early to your employers, because more often than not, you would see that an employer would be actually quite supportive of that, because at the end of the day, what the employer is looking at is to be able to cover that gap, if that gap is for a couple of months. And obviously, if it is beyond that, then the question is, would the person actually want to come back? That early communication with your employer is an absolute key, so that they're able to actually plan in advance. And you would be very surprised that a lot of employers are actually quite supportive of this. And yes, we do tend to enter these conversations with our clients as well. The way we try to speak to our clients is that we tell them not to frame this as a break, but as an investment in themselves. Because we have seen that a lot of this mini retirement plan is not about taking the time off, but it's also spending time with family.
According to that HSBC survey, the affluent are jumping onto the mini retirement bandwagon as well. But surely the planning and preparation will be a lot easier for them, no? Here's Ishan from HSBC again.
The planning will definitely be different. And to be honest, it also differs from individual to individual. It depends on the size of the expenditure of the mini retirement fund as well, so on and so forth. But I think the one major difference would be the access to the products. So that obviously means that they will have a different plan as opposed to the others.
For the more affluent, what we find is many of them want to travel the world and explore things that they just haven't had the time to do. So in such a scenario, to make sure you plan to ensure that you have enough funds to fund your mini retirement for you to be able to achieve some of these goals, we think it is very important for you to stay invested in the market, but to also make sure that your investments have certain amount of flexibility and liquidity for you to draw on to fund this mini retirement.
Maybe beyond traditional income streams, there are alternative or passive income strategies we can explore before and during a mini retirement to provide financial flexibility and peace of mind. Jason from Syfe?
When you look at an alternative income stream, it's very important to obviously build up that cushion before your mini retirement and not during your mini retirement. During your mini retirement is obviously when you want to focus on yourself. I would like to break down the alternative income streams into two main categories. One is the passive, and then the other one is more of the active. And in passive, you have different asset classes like bonds, where they have a distribution yield, say REITs, for example, where there is also a very consistent cash flow. You don't have to actively invest your time and effort. On the other hand, it's more of the active income streams where it depends on, say, your skill set, whether there's a particular niche that you can offer and build up that alternative income stream. So both of this put together, what ultimately it does is it provides you a mental mindset where you can be more reassured financially, such that when you go on your mini retirement, the finances are there and working for you already.
The advent of alternatives started on the alternate space a few years back, but now we see that alternatives are being launched for people within the high net worth section as well. So to me, I think alternatives will be part of, and a very important integral part of people's financial planning and their portfolio as well. Private equity, private credit, hedge funds. So essentially, you have a public market and then you have the private market. So anything to do with the private market. But I think a lot of changes has happened on the private side as well. The fact that we have a lot of big players now actively taking part on the private market, and the fact that there are greater due diligence done on this, there are greater regulations which is regulating the private market. The fact that there is greater understanding as to how these products work, not just by the clients but also by the regulators, means that there is a greater transparency on how this private market works. Now, does that mean that the liquidity risk is the same as the public market? The answer is no. And hence, the risk appetite or the risk profile of any client becomes very important when they invest in private market, because it is true that it does carry with it illiquidity risk, and also it is less transparent than public markets.
Takeaway order Money Hacks 244 is ready for pickup. Mini retirements are achievable. Project U pauses are not just for the wealthy. Make sure to plan with dedicated funds, a realistic budget, and professional guidance. Consider re-entry and alternative income streams. Crucially, communicate early with your boss. It's an investment in yourself, not just a break. A big thank you to Ishan Sarkar from HSBC.
Thanks, Howie.
Nick Tong from Rowe Price.
Thanks again, Howie, for having me.
And Jason Ang from Syfe.
My pleasure, Howie.
And this has been Money Hacks by the Business Times.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.